New data from the Commonwealth Bank and NAB has revealed 90% of Australian borrowers are continuing to pay above the minimum on their home loans, even after recent RBA interest rate cuts. So far from easing off, they're digging in and paying down loans faster and potentially saving thousands. Finance and money expert Chris Foster-Ramsey says this trend signals not only financial confidence, but a growing appetite for long-term security. Let's check in with him. Good morning to you, Chris.
Good morning.
Why are so many Australians choosing to keep their repayments high despite having the option to reduce them?
Yeah, look, I think there's a couple of reasons. One is that they see the benefits in being able to pay down the principal on that loan with additional repayments, which also builds up a bit of a buffer when it comes to, extra money paid down in their home loan. So it potentially saves them time in terms of the years paid back and the interest. And the other way around, to do with this is, as someone said to me the other day, perhaps people see it as, getting used to the new normal. And if rates move again the other way, then, it's not so much of a shock to the family budget. So there seems to be a 50-50 sort of argument on both sides there.
I wanted to go there actually and ask whether the trend was more about a financial strategy or fear of future rate rises. And it seems it's
both.
Yeah, a bit of both. So how much can borrowers potentially save in interest by maintaining these high repayments over the life of a loan?
Oh, look, it would be tens of thousands in just at a high level by paying additional, keeping the repayments the same, even though the minimum repayment required will have dropped down in line with the RBA rate cuts in February and May, and the one that was sort of meant to happen last week but didn't, which hopefully we'll see again soon. And I think that, you're not only saving money, but you're also saving the amount of time. So by just as an example, paying what the data we see by paying fortnightly or weekly instead of monthly, can save anywhere between 3 and 5 years off a 30-year loan in most cases, just by doing that. So the time is saved, interest charged is saved, and you're getting a little bit ahead and a bit of a buffer on how much you can access if you need to.
What about those with other debts or tight budgets? Is it still wise to pay extra on a mortgage, or are there smarter ways to use that money?
Yeah, I think that's the other part to this, is that there are definitely some that are still feeling the pinch, and I would say to those people, just keep doing what you're doing. One foot in front of the other. This will come to come to a relief at some point for you. So reach out to your broker or your lender or your banker if you need to revisit minimum repayments and getting those direct debits down to give you some relief in the family budget. There's no point being a hero here, trying to pay everything down while other stuff remains late that's charged at a high interest rate, credit card or personal loan or car loan rates. So, this is an example of in CBA and NAB's view, 90% of what they're seeing, but there's also an argument there that there are people that still need some assistance in dropping their minimum repayments to the new level.
You mentioned credit cards. I was reading somewhere where the Reserve Bank wants to end debit and credit card surcharges in Australia. So how would they move on that, do you think?
Oh, well, hallelujah for that, for starters. I think that, that's a long time coming and a very welcome change. I think that, the logistics of that we'll wait and see, but, you would think it probably would just be a software upgrade amongst the machines and the merchant terminals to make that happen. But certainly, the credit card surcharge fees and the profiteering from that we hear about every so often is definitely a policy that needs to change. And I can see why people do it. Vendors do it, but I don't agree with it. And I think that if that's mandated, in the same way that cash should remain legal tender for forever and a day for those that use cash and need to use cash. So I think there are two things that are on the agenda there from the government side that seem to be making progress, but a very welcome change in my own view.
Here. Now, with more rate cuts possibly ahead, what should borrowers be thinking about now to stay financially resilient?
Yeah, so I think that just going back to the weekly or fortnightly repayments, if you need to adjust the repayments to the minimum level, that's okay, but perhaps see if you can work out a budget or speak to your broker or your lender or your banker about how they can help you do that. Dividing by 4 for weekly, dividing the monthly minimum repayment by 4 for weekly, by 2 for fortnightly. That's going to buy you some time in terms of the speed that you're going to pay that loan down. And the theory behind that is, if you're paying monthly repayments, you're only paying 12 times a year, fortnightly is 26 and weekly is 52 times a year. Those 26 and 52 times a year make a massive difference to the amount of interest charged and the way the amount of interest is charged on that loan over the 30-year or 25-year loan term. So that would be the top 2 tips that I would recommend. In addition to reviewing your home loan interest rate, there are reasons for dropping those rates by the RBA, and you should be on something if you just have a vanilla home loan and you have a salaried role. You generally speaking, you should be on something under 6%, and heard from your broker, your lender, or your banker in the last 3 months to have that reviewed. So they'd be my 25 words or less sort of tips around what to do.
Broker, lender and banker, is that like butcher, baker and candlestick maker?
May as well be.
Chris, always great to chat with you. Thank you.
Thanks, Kim.